So next we have Lukasz de Pourbaix, who is the Global Cross-Asset Strategist at Fidelity. We're going to be talking about the contrarian mindset and the battle against behavioral bias. I would suggest to you that I've been running money for a very long time, and for any of you that are new to this or been doing it for 30 years, that battle against yourself is probably one of the first things you got to conquer. So please give your full attention to Lukasz.
Thank you, Nathan. So the battle against contrarian mindset. So today what I'll be sort of talking about is a little bit about the behavioural biases and why it's actually hard to be a contrarian, not only in investing but in life. I'll also talk about why is it maybe an interesting time to look at contrarian investing, and then sort of wrapping it up with how Fidelity reflects contrarian investing and how you may think about it from a broader portfolio perspective. So if you think about, and I sort of cast my mind back when I was at school and then my kids, I got 3 kids, and if you reflect that time when you're sort of growing up and you're at school, being different is very hard. And if you sort of, certainly if I reflect on my kids, trying to belong is a big part of growing up. But it's sort of really hardwired into us, isn't it? Trying to belong and being different from the crowd is uncomfortable. There's a risk you're going to be wrong. You're going to, you've taken some kind of view and everyone else is going to be laughing at you. So there's an embedded aversion to being different and to being contrarian. But why is it interesting at the moment, if we sort of think about it from an investment perspective, why think about contrarian investing now? And I would argue there's 2 fundamental reasons why you may consider looking at strategies that are more contrarian. One is we are in a period where we're seeing significant dispersion in returns between regions, returns between sectors, returns between stocks. So significant dispersion. Dispersion coupled with you're seeing significant parts of the market which are being fueled by momentum. And that's momentum to the positive side, i.e. stocks going up in a particular part of the market, but also momentum to the negative side, which is quite interesting because it's very much related to that sort of dispersion story. So it doesn't mean that being different is going to be correct, but I think it does warrant at least having a look and exploring why we're seeing some of this phenomenon and how maybe there's opportunities that this type of dispersion and these sort of momentum trends might bring to us. So if I think about, look, there's in terms of how I think about contrarian investing, and I'll sort of put it down to simply having a deep sort of critical thinking mentality and really considering the counter view to the orthodoxy. And that may be the counter view both to the negative but also to the positive, because sometimes it's not only why may markets go down, but also why may markets go up further than we expect, than they already have been. So it's not always a negative thing, but it is that deep, I guess, counter-cyclical sort of perception, which is a little bit different from the other sort of style of investing. Value, you're looking fundamentally in price, and then obviously mainstream investing, there's generally sort of a quality tilt. There's generally sort of a thematic, a good story, and so forth. Whereas the contrarian investor generally doesn't have a good story. There's no nice theme they can sort of point to. There's no sort of trend. And your return profile by being a contrarian investor is very asymmetric in nature. And so what I mean by that is that you tend to get your performance back very sharply in a short period of time, but you can also be out of the market for an extended period of time. So it's not for the faint-hearted. So if you're there watching the benchmark every day and you're trying to look at these type of strategies against the benchmark, well, it's going to be a wild ride. You'll probably have a mental breakdown before you get that return back. But that's what you're getting into. For true contrarian investing, it's patience and it's being comfortable with being against the tide. And if we explore some of those, those behavioural biases, and I sort of, these are obviously pretty common sense, comforting crowds, fear of, feeling losses more than gains, and recognition for others, social validation, loss aversion, emotional crowds. If related to our industry, the industry we are in, so if you think about comforting crowds, now for all of us that are running, whether you're running a multi-asset portfolio, whether it may be just a sector portfolio, whatever it is, you probably benchmark against some kind of peer relative benchmark. So it could be a peer relative. If you look at the super funds out in the market, a lot of them internally as part of their KPIs will have some kind of peer relative assessment. If you think about just normal investing, there's an index. And so deviating from that can be quite difficult, because then you get, your clients will start asking you questions internally as a business. Why are we underperforming? Why are we out of the market? So there's this whole sort of, comforting, it's easy to, the whole old analogy, you're never going to get sacked for buying IBM, right? Like, it's sort of a similar concept. So as an industry, and this has been a topic that's, it's not new, but the concept of peer relativity and peer risk is definitely still there. It hasn't gone away. And that is very much sort of, I think, related to some of those behavioural biases. Loss aversion, and this is really about career risk as well. So, if you're managing a portfolio, whether it's a managed account, whether it's a fund, whatever it may be, significantly underperforming or significantly deviating from the benchmark, from the peers, at some point people are going to, you might have a governance committee, whatever it may be, they might go, well, why is that so? And it's interesting if you look at, again, some of the industry ties that we've seen over the last couple of years, things like the APRA performance test, and you've seen this sort of narrowing of taking risk, because it's the cost of taking more risk away from the benchmark is higher and higher. So career risk is a real one. And then agency risk, that's the sort of personal risk versus sort of the client's best interest. So these are, and we're all, I'm not saying here that everyone's exposed to this. The reality is these are behavioural traits that all of us, whether you're a fund manager, whether you're an advisor, whatever, we're all prone to these biases. It's just the reality. It's human nature. And there comes the music on time. But if I sort of think about this, then from a sort of thinking perspective, and if I think about the contrarian investor mindset, and some of you may have read Daniel Kahneman's book, which he wrote I think it was 2011, and it was this whole concept of fast and slow thinking. And the fast thinking he sort of termed system 1, and the slow thinking he sort of termed system 2 thinking. And again, the majority of us, we use system 1 thinking, which is just sort of quick, reflexive sort of thinking. It's instinctive. There's not a lot of sort of deep layers to this. But this is how we tend to operate 95% of the time in terms of how we think. System 2 thinking is really that slower, rational, deeper, a lot more effort in terms of thinking, and we use that about 5% of the time. Now, I would argue, as being a contrarian investor, because you are naturally exposed to some of those behavioural challenges, you are really starting to really focus a lot more on that system 2 thinking and looking, several levels below to get that investment thesis. So you're trying to harness that system 2 thinking as much as possible. And so if we get to the investment side of things, and if you think about momentum. So momentum, we're sort of looking at the measuring sort of price acceleration. And momentum as a factor, this is looking at it for global equities. Momentum as a factor, so that, when you think about factor investing, people talk about value, people talk about growth, quality, etc. Momentum is the most effective factor out there in terms of, it's empirically proven that momentum works most of the time. And it works most of the time, and it works certainly effective in terms of shorter time periods, so your 6 to 12 month period. So why would you go against this? Because contrarian investing, I would argue, is the antithesis to momentum investing. So why make your life harder, right? Just ride momentum. And if you think about momentum today, and I'll explore this a little bit further, there's good examples in today's market where we're seeing this play out both to the upside and to the downside. But there are periods where momentum breaks. And this is looking at the MSCI, and it's sort of measuring the momentum factor. But you sort of cast your mind back, for those that were in the markets, whether it was during the tech bubble, whether it was during the GFC. So if you think about the GFC and you reflect on that time, and whether you're in equities or in credit markets, for example, in equity markets, obviously you saw, the whole market sort of sold off, but certainly financials was a good example of one part of the market where, irrespective of whether you were good, bad, or what, we had a good balance sheet, good business, poor business, correlations went to one, everything sold off, right? Same if you looked at credit markets, didn't matter whether you held quality credit, whether, the assets were actually defendable, correlations went to one, everything sort of sold off. So there are periods where momentum breaks. It's very hard to sort of determine when this happens, but it does happen. And when it happens, markets dislocate and that momentum factor just crashes, right? So momentum works most of the time, but it doesn't work all the time. And there are periods, obviously, that we know that that breaks down. So if you think about today, and I'll point to two examples, obviously pretty obvious ones, but on the left-hand side here, we've just got, it's just looking at 12-month forward PEs. I don't have the numbers there, but the numbers aren't important. But if you just look at the sort of relativities, you can see on the left hand, you've got US equities, MSCI USA. This is just pure valuation. And on the far right, you've got China. Now, this is really a great story of momentum, right? So on one hand, the long US trade is well and truly in play. It's worked. It may continue to work. Valuations, arguably, you can argue are higher. But I guess one of the differences, even if you talk about some of these tech companies, unlike, say, the tech bubble, a lot of these companies actually have defendable earnings, right? It's not like just made up. On the flip side, you've got China, whose valuations are at arguably record low levels and continuing to go down. So if you think about China, 2003, you saw record capital outflows out of China in terms of the economy. If you look at your average, when we looked at sort of average global equity managers, before 2023, the average holding to China in their portfolios was 5%. The average holding today is 1%. If you think from a relative index perspective, what does that look like? So prior 2003, they were positive 1.5% overs. Now they're negative 1.5% unders in terms of underweight. So basically, it's been a massive move out of China. The talk about, is China investable? Basically, if you look at the Chinese stock market, and Fidelity has a range of strategies, obviously investing in emerging markets, in China as well, all stock correlations have gone to basically to one. There's no place to hide in terms of Chinese equities. Now, there's a good reason why the Chinese market's gone down. It's not to say that it's irrational. There's an element of rationality. Obviously, if you think about the two big ticket items, one from a systemic structural perspective, just geopolitical risk, and that's a real risk, and it's not going away. But there's also a cyclical risk, and that cyclical element is around the property market, and time will tell how that sort of plays out. But what I would argue is always interesting to look at, now it doesn't mean to say invest in China today, but all I'd argue is in any market environment, whether it was the GFC, any big market dislocation, when you get a part of the market where everything correlates, everything goes down and that momentum continues to, it's interesting to look at. Because from an investment perspective, again, there might be companies that have been oversold, quality companies with strong balance sheets. So even if you look at the stock like Alibaba, I think it's trading on 8 times forwards. It's got a very strong balance sheet. Yes, there is more competition coming through, but the growth is still there, right? So unless you're of the view that China is uninvestable, and that may be a logical view. But unless you're of that view, then I think it's an interesting one to look at in terms of a contrarian position. And it's very uncomfortable because I'm sure there's a lot of clients, and certainly when I've spoken to clients, that one of the main conversations is, what's your exposure to China? So that's the momentum going down in a part of the market. And everyone knows this, obviously, in terms of the sort of other side of the ledger, the momentum going up is, if you look at US, mega caps, Magnificent Seven, all of that, and I'm not going to go through it in detail, but obviously we know that there's a very narrow part of the market that has driven the US market in particular, those large mega cap, anything AI sort of related and so forth. But the interesting thing is on the flip side, where you've seen this, again, this heavily momentum trade. And what makes it interesting is when you start seeing companies, and it reminds me of other cycles, but when you start seeing companies that have got nothing to do with AI, but somehow in their marketing documents somehow latch onto this AI theme and you see their stock price go up, right? So that becomes interesting as well. It's sort of the inverse of the China story, right? Where suddenly you just have a whiff of AI and your stock price goes up. So not saying that there's no legs to this, they're not saying that this is incorrect, but again, it's another example where you're seeing a heavy momentum play into one part of the market, and we've all seen those in NVIDIA sort of charts in terms of that upward trend. So there's sort of two thematics, two sort of, parts of the market where you're seeing clearly heavy momentum, heavy correlation, either positive or negative, in certain parts of the market. So if you think then of a typical contrarian portfolio, you're really, one of the biggest battles you're fighting is the battle of value traps, right? And the reality is with a contrarian strategy, you're probably going to have some value traps in there. But the whole idea is to get more or less of those value traps, and get more sort of high alpha opportunities. So you're going to have businesses that look ugly. You're going to have very high active share. You're not going to look very similar to the benchmark. You're going to have very high tracking error, probably very high stock-specific risk. I mentioned sort of risk of value traps. But I think the other thing is, in terms of your investment time horizon, and it is very much a long-term investment time horizon. So if you've got a sort of 12-month sort of view on things, this is probably not the strategy, a type of strategy for you, because you can be out of favour for an extended period of time. And as I said before, your return profile can be very asymmetric in nature, okay? Because you can be out of the market for extended periods of times. I won't go into this, but just to give you a sense of how Fidelity reflects their sort of contrarian views, a global long-short strategy, concentrated, beta 1, 130-30, but very contrarian in nature, and I'll show you some data which sort of shows. The broader strategy offshore has been running for over 10 years, so has ridden a couple of different periods in the market. But as I'll show you, it's got some interesting sort of characteristics. If you look at the long book, again, a good example of a long book would be a stock like Rolls-Royce. So Rolls-Royce has been a position in the portfolio for some time. Many obviously aware, obviously in the aircraft business also has some exposure to defence, effectively operates in a duopoly. But the challenge for that stock for many, many years has been in terms of management, capital allocation. That's where you've had the issues. Now, these are sort of a classic type of company where we'll like to sort of observe and have a really strong sort of understanding of management track record, where they've come from, how they've behaved in previous maybe companies. And this was a good example where we did see that the new management come in and really restructure that business in terms of how they allocate capital within the business. And you saw that turnaround. Now the stock's looking a lot more attractive, but back in the time when we invested in it, it was a pretty ugly stock. The other sort of, if you look at the sort of short side, sometimes it is some of these overhyped areas. So I remember talking to the portfolio manager about this, and a few years ago, he was shorting a big stock. It was actually a stock to do with ESG. So it was an ESG stock, right? It was branded an ESG stock. This company went out, branded themselves as ESG, all the rest of it. And the reality was there was not a lot of legs to it. They were just sort of putting this out there to sort of capture a theme. They weren't genuinely sort of an ESG focused company, and we shorted that type of strategy. At the moment, we do have, and you'll see a significant underweight to some of the tech sector. It's a big underweight to that sector. And some of the companies we have shorted are companies which we think are really poorly managed, but also they're linked to some of these sort of, call it the AI theme, we would argue is fairly tenuous. So you're very much looking at, say, the type of positioning you're going to be looking at is very counter to what the market or the index will look like. Now, this is a little bit difficult to read, but basically, if you're running this type of strategy, as I mentioned, momentum works most of the time, but you're fighting against momentum, right? So that bottom chart, this is for the strategy, offshore strategy that has been running for sort of roughly around 10 years. The momentum has obviously been a headwind for the strategy quite significantly. If you sort of look at the scale there, you can see it's just been trending, in terms of contribution to returns, it's been trending down quite considerably. So the trick is with a contrarian strategy, you've got to hopefully then deliver the alpha through stock-specific ideas. And if you look at the top chart, and again, the scale's a bit hard to read, but you can see that over time, the alpha from stock-specific risk has been quite considerable. But it is going to be a wild ride. So it's not a nice linear experience in terms of portfolios. And you can see here, I've just highlighted some of the index relative positions. Very underweight US, very underweight tech, a little bit overweight China, all the things that probably your client, you're worried about, China, all the things that, counter to what has worked. But again, it's not a top-down view, it's very much a bottom-up stock-specific view. And again, I'll reiterate, some of these parts of the market have been very, your US tech, very high momentum sort of parts of the market, which may be right, It's not saying that they're going to be wrong. So if you think about then from a portfolio perspective, how do you sort of, grapple with having this sort of interesting strategy, very index unaware, probably lowly correlated to the index, is going to give you a very different type of exposure, probably going to have high levels of volatility. What do you do? And I sort of think about it, the way I sort of think about it is that for your typical global equity portfolio, now whether you're holding an index exposure or whether you're holding an active exposure, and the reality is if you're holding an active exposure, you're still going to be probably piled up, give or take, plus or minus 2% into some of these high momentum categories. So inherently your portfolio, whether it's conscious or not, or subconscious, you're going to have a lot of momentum just because of by nature of what the market's been doing in recent times. So the way I think about a contrarian strategy is really a bit of a hedge against momentum. So it's sort of saying, you know what, 90% of the portfolio is doing its job and it's done well, and it may continue to do really well. It's not saying it won't. But what is my hedge if that scenario doesn't play out? If you get a dislocation in momentum, you get a surprise, whatever it is, right? So in some of these high momentum plays, what's your hedge? And there's a number of ways to do it, but I'd argue one of the ways is to sort of have a satellite exposure, and position sizing is very important. So you're not going to put in 20% of your book into a contrarian strategy, but you may have, call it 5% type of allocation to that strategy to give you that sort of diversification, that hedge, should the consensus playbook not play out. So there's a role for some of these strategies. So if I sort of wrap up, because I think I'm in red here in terms of time. So really, if I think about contrarian investing, it really is, it's a psychological battle. It is a counterbalance to what we're all hardwired to do, right? It's very hard to stick, if you're an advisor talking to a client, you've got this strategy, it's looking ugly for you. It's a hard conversation, absolutely. But from a portfolio perspective, you are getting a lot of exposure to stock-specific risk, idiosyncratic risk, very different from the benchmark, and you are getting a genuine sort of hedge against that momentum should that not play out. And I think the time horizon is very important because, again, contrarian strategies are not a short-term play. So I'll leave it there. If there are any questions, happy to answer those, but thank you for listening.
I think there's a question in the front there. I think there's a question in the front.
Question? Yep.
Sorry, my apologies. No, that wasn't. Sorry, is there a question from the floor? Lukasz, I had one for you, actually.
Yeah.
And by being a contrarian, I sort of think to that herd mentality where, you lead from the front, but sometimes you got to look back and make sure other people are following you, make sure you're actually right. But what happens, when do you acknowledge that you're running by yourself and you got it wrong, and you really do have it wrong? When do you make that decision?
It's a very hard one, and I would say one of the most perfect ones if you look at sort of crypto, right? So you think that herd mentality.
Yeah.
And you're seeing it at the moment where you see that momentum, and everyone's probably watching. It's like a circle with people with guns at each other. Everyone's sort of watching who's going to be go out first, who's going to stay behind. So what I would sort of argue, look, it's very hard. It's you can use momentum. One of the things, if you're running an asset allocation process, I would argue, which is quite useful, is obviously a lot of frameworks will have a valuation sort of methodology. You might have a more sort of cyclical sort of factor, but monitoring momentum because momentum is a pretty quick indicator. So measuring that on a continual basis in terms of what the trend is can be a useful indicator in terms of is momentum turning, is there something structural in this? So I'd argue just if within your own models maybe have a momentum factor in there and monitor that.
That's good advice.
Lukasz,
Yep.
Thanks for those insights. We often see fund managers, particularly in concentrated portfolios, fall in love with stocks and they don't have a sell discipline when it comes down to it. So what do you look for in terms of Fidelity's portfolio managers in terms of their sell discipline?
So this, in terms of this strategy, it's a quite unique strategy. So if anyone ever gets a chance to meet the portfolio manager, he's actually quite an interesting guy, very Russian and very contrarian. So it's a very interesting guy. But look, in terms of a contrarian strategy, sell discipline is difficult because, and Dimitri will openly say, look, I will have value, there'll be value traps in this, but my goal is to get more stocks that generate alpha. So what you tend to find in this type of portfolio, that stock holdings are long in terms of period. And fundamentally, it really just comes to the investment thesis. I was actually recently talking to the portfolio manager because there's some stocks that have been going the wrong way for them, and just getting a sense of has the thesis changed, and that's fundamentally what you need to go by. But absolutely, I think with a contrarian strategy, not just this one, but any contrarian strategy in the market, the risk of value traps is higher.
Can leave it there. I'll take care of that. Thanks, Lukasz.